The big four banks have now followed the RBA's June interest rate rise after it increased the cash rate by 50 basis points to 0.85%. Joining me now live is Evan Lucas, Chief Market Strategist at InvestSMART. Evan, good morning. Thanks for joining us. The fallout from Tuesday's rate rise is certainly continuing. Are we going to see a collapse in lending and new loans?
Good morning, Danica. That's certainly what the market is forecasting. Under theory, normally, actually, raising interest rates are good for banks and good for net profit for banks because their ability to actually generate more income out of the existing loans that they have gets higher. The margins that they can extract gets higher. So under theory, that's what you should normally see, and that's what everybody was expecting to see on Tuesday afternoon and then yesterday. What we saw was the complete opposite. Banks fell, like Westpac, by 6.5%. You saw CBA and also NAB down about 5% and ANZ down about 4%. And the reason for it is exactly as you said. What the market is now expecting and what most analysts are suggesting is that because of this jump, because of the expectation of further rate rises at the same level, 50 basis points or more, that lending and actual new lending is probably going to actually slow. Some are even forecasting it could collapse. And that has been the big driver in banks in terms of their overall market price, is that the lending that we've seen during the post-COVID period has been quite strong and probably above trend. What the market now believes is that because we're going to have such a hit to our confidence and belief that the costs of actually borrowing are going to get out of our actual ability to do so, the banks therefore won't find lending that easy at all. And that's what at the moment now has now been asked, is whether or not this also creates a bit of a squeeze in credit because nobody's going to borrow.
Yeah, a lot of unanswered questions remains to be seen. And tomorrow morning sees the release of the US inflation read for May. Are there any signs that inflation is slowing down?
In the US, there is. And look, this might be what we just discussed to take heart here in Australia, because we're about 4 to 6 months behind them in terms of that inflation story. In the US, things like used car sales and used truck sales, things that shouldn't actually grow in price, which had been growing in the US, has finally started to ease off. We actually saw those prices fall by about 15% in May. If you look at things like semiconductors, those that have been a massive shortage, they've actually fallen by half in price over the last month as well. There's also signs that things like lumber and construction material in the US is starting to ease. Certainly not saying it's the end of the whole problem. We know around the energy crisis, that's not just an Australian story, that's global. But there is signs, just small signs, that inflation is finally starting to peak. And we are likely to see the similar things here in Australia, probably more around September. So it's why watching what happens in the US is a good thing, because we saw what they are going through in December and January for us now. They are now starting to show signs that they're easing off, and that therefore would suggest that we could probably see the same in September and October.
So a couple more months to go yet. And just finally, what's likely to happen on the market today?
So we are following that US lead, leading into that sort of CPI read. It's going to be a negative day today, and that's okay. As I said, at the moment, the market's trying to get any information it can to understand the inflation story and where central banks around the world are going with interest rates. Are they going to be as hard as they're forecasted, or is there signs that they could actually go a little bit slower than probably currently sitting in the market pricing?
Evan Lucas, good to speak with you. Thanks for joining us this morning.